Are you wondering if real estate is a great investment? Many Australians believe that owning a real estate is the sure pathway for wealth. But numbers show that investing in the share market gives better returns, higher liquidity, and fewer hidden costs. In this video, I'll walk you through the data, show you why properties are often driven by tax incentives, and explain why stocks should be your first choice and only invest in property as a supporting role. Before we begin, just a short disclaimer. The content above is for educational purposes only and does not represent personalized financial advice. Always consult a licensed financial advisor before making investment decisions. Hi everyone, before we continue the video, starting on November 28 to December 25, in the spirit of Christmas, we'll be giving away $80 a day. Yes, that's right. You see, the reason why we're doing this is because I know that everyone's struggling because of cost of living, housing market, or any other circumstances that's happening in your life. Now, I've been blessed all throughout the years. Have a good family, doing well in life, and I'm currently in the position to give back to my community. Believe it or not, I actually started as a student migrant here in Australia, which is why it's important for you to understand that when I was broke, I always hoped that someone would be able to help me in any shape or form, which actually happened a bunch of times. I have a lot of friends who helped me through hard times, which is what motivated me to do this giveaway. For you to qualify, all you need to do is subscribe to my YouTube channel, comment down below the hidden word which will be revealed later on in this video, and send me an email to show that you're subscribed to my channel to this email address. Alright, first thing that we need to talk about is stocks versus property. When we talk about shares, it means that you own a percentage, large or small, of a company that's publicly listed. This would be companies like Apple, Tesla, and Amazon. In Australia, we have ASX 200, which means you have 200 publicly listed companies here in Australia that's bundled up together into what you call an index. And in 2024, if you invested money into the ASX 200, it would have given you an 11.4% total return. It means that if you've invested $1,000 to the ASX 200 by end of 2024, your money would have grown to $1,114. This is basically including dividends. Dividends are the profits that the companies share towards its shareholders. And this percentage outperforms the housing market at the same period because the housing market only grew by 8.3%, while international markets such as the American S&P 500 index have historically grown by 10 to 11% annually over long periods of time. And that is a basic example of compounding on steroids. And shares are classified as liquid because you can easily convert it into cash. And it doesn't even have a high transaction cost, unlike properties where it gives you a bunch of costs when you're trying to sell it. And the bonus tip is it's also easy to diversify. Now, let's talk about properties. The median house price across combined capital cities rose by 70% from the year of 2013 to 2023, from $520,000 to $882,000 per house. But if you factor in all the costs, then it actually only rose by 50%. And for apartments, it grew by 43% on the same period. But in fiscal year 2025, houses in some cities only grew by 3.7%, showing a slowing momentum. And property comes with larger costs: stamp duty, maintenance, loan interest, management fees, which eats into the net return. Most properties, especially in Australia, is mainly driven by tax incentives. You see, most of the wealthy people use this loophole to make sure that the governments can't tax their hard-earned money. In Australia, when you have an investment property, there's a thing called negative gearing. What it means is that you can claim all your losses against your tax so that you only have to pay less to the government. The list of the tax deductions would be interest on the investment loan, property management costs, and most importantly, the depreciation of houses and buildings. Let's talk about property losses first. Let's say you rent your property for $400 a week, but your property management fees, repairs and maintenance, insurance, council rates, and home renovations or improvements costs a lot more than what you earned that year. Then you can apply negative gearing. This means that all these losses will be deducted to your taxable income. And not only that, you could add on all the interest that has been paid on your investment home loan and try to deduct that on your salary as well. Now, the truth is, the people who's actually smart investors don't use this as the basis of buying properties. The reason why is because who would want to lose $1 just to get back 45 cents? 45 cents because the highest tax bracket out there in Australia is at 45% of their taxable income. Which means if you earn $200,000, $90,000 of that would go straight to the pockets of the government. The truth is, if you're an investor, you would rather want to make money out of the money that you invested than to lose money. Now, I know what you're going to say, but John, what about the capital gains? Look, we've already established that properties give slower returns than if you invest your money into the stock market. So, why do millionaires and billionaires keep on buying investment properties? Well, the truth is, it's for depreciation. In Australia, for properties that are built in 16th of September 1987, you can claim capital works at 2.5% per annum over up to 40 years. This means that if your property is valued at $1 million, you can use $25,000 to deduct on your taxable income. And the thing is, you can keep on doing this over the next 40 years. The question is, why is it called depreciation when the property value keeps on increasing? These incentives make property very attractive for people who are earning more than $200,000. And they often prioritize tax benefits instead of cash flow. All right, everyone, here's a short break. As promised, the hidden word for this video is blessed. So make sure to comment, subscribe, and send me an email to this email address. And I hope that this giveaway will help you out in any way possible. Merry Christmas, everyone. What are the risks, costs, and trade-offs with property? There's always high upfront and ongoing costs. There's stamp duties on purchases. Sometimes you even have to pay lender's mortgage insurance, conveyancing costs, and if you're going to buy an apartment or a townhouse, you're going to have to pay ongoing body corporate and strata fees. And last but not the least is repairs and maintenance. Borrowing for a property is also risky. The leverage risk is that many investors out there borrow large amounts, increasing their risks. Because if interest rate increases, then the money that you have to pay the bank also goes up. And the problem is, what if your tenant decided to stop paying rent? Then you have approximately around 6 months before you can even get your property back. Take it from me, guys, because I'm an asset manager, and this is how long it will normally take to evict someone due to lack of payment or squatting in your property. Another risk would be slower capital growth. You see, everyone is panicking over fear of missing out because over the past 4 to 5 years, property market has gone up drastically. But everyone forgot that within 2015 to 2019, prior to COVID, most of the property has actually plateaued or flatlined. You see, COVID is a big disruptor, and we don't actually know when the next disruptor is coming to increase the property growth. Another risk is that because of these tax incentives, the focus might fall into buying the properties just for tax instead of sound investing. Now, why should you pick stocks? As discussed earlier, it has a better growth and flexibility. You can invest in small amounts even $500 to $1,000. And diversify across multiple sectors. You can invest in real estate, technology, manufacturing, mining, or whatever you want to invest on. And the best thing is you can sell it easily. It also have a strong historical performance. As an example, ASX 200 on FY25 delivered a 13.8% return, including dividends. Historically, the share market has delivered strong returns, compounding over long periods of time, decades. It also have lower transaction or holding costs compared to property. There's no stamp duties in most cases, fewer maintenance bills, and easier tax treatments. Liquidity means you can easily react to more better opportunities. Now, I'm not saying you shouldn't buy properties. When should you buy properties? Properties can be a good investment as a diversification tool or for tax purposes. This is the reason why the millionaires and billionaires love properties, because they can get away of taxes. But you shouldn't buy a property as your first wealth building asset. If you already have a good share portfolio, stable cash flow, either income or dividend, and if you've seen a property that meets good fundamentals, such as location, rental demand, and minimal risks, then property can be a secondary role. Use property like the rich as a tax incentive. Focus on depreciation and accept that your core wealth engine would still be on stocks. To summarize the video, first you need to focus on stocks, either ASX 200, S&P 500, or selected ETFs because they offer better returns, liquidity, diversification, and lower holding costs. Second, view properties in Australia not as a main investment, but as tax incentives. In short, build your wealth through stocks and choose properties as a way to diversify your assets and to increase your tax incentives. And not just because you simply believe that it will double the price within 10 years. Because the truth is, you might be in for a rude awakening if that's how you think. If you like this video, please like and subscribe so that we can continue on creating videos like this to help other people. I'll see you next time.